Good day and welcome to the D-Marq-AnalyticS channel. For this week, we will be looking at batch 12 of 12 of 5 stocks. This is just a suggestion for you all to consider and research, and certainly not financial advice. Let's get started. The first stock in our video today is Micron Technology, ticker MU, in the semiconductors industry. Micron is one of the largest semiconductor companies globally, specializing in memory and storage chips. Its main source of revenue comes from dynamic random access memory, DRAM, although it also has some involvement with NAND flash chips. Micron serves a diverse international customer base, providing chips for data centers, mobile phones, consumer electronics, as well as industrial and automotive applications. The company operates with a vertically integrated structure. Its stock has had better total returns when compared to the S&P 500 over the past decade, and even recently. It has a current ratio of 2.52 and an Altman Z Score of 4.25, with $37.38 billion in revenue. It has a return on invested capital of 14.76%. Micron's advanced HBM3E memory technology positions the company as a key supplier for NVIDIA's latest AI accelerators, supporting significant and stable growth. The CHIPS Act and US manufacturing grants create a level playing field, giving Micron a competitive advantage over Korean rivals as production shifts to America. Micron is benefiting from data center expansion, shortages in HBM and DDR memory, and strong pricing power, with sales nearly fully booked through 2026. Additionally, new HBM4 products are driving innovation. The company is also experiencing margin expansion and rising return on invested capital, ROIC, along with support from the US government, which enhances its position as a strategic asset with reduced geopolitical risk and ample funding for research and development. Furthermore, Micron is seeing robust demand across various sectors, including data centers, PCs, smartphones, and the automotive industry, contributing to a multi-year growth trend. In Q4, MU's revenue surged by 46% year-over-year, exceeding expectations. This growth is driven by accelerating demand and rising prices for DRAM and NAND memory products. The second stock in our video today is Welltower Inc., ticker WELL, in the healthcare real estate investment trusts industry. Welltower owns a diversified healthcare portfolio consisting of 2,391 properties across the senior housing, medical office, and skilled nursing, post-acute care sectors. This portfolio includes over 100 properties in Canada and the United Kingdom, as the company actively seeks investment opportunities in countries with mature healthcare systems that operate similarly to those in the United States. Welltower has a strong credit rating of A-, with a dividend safety score of 80 and a fast dividend growth of 10.4%. It has a low payout ratio and a low net debt to capital and EBITDA. In the past recession, it had better returns than the S&P while maintaining its dividend payouts. Given the aging population and the anticipated increase in healthcare expenditures for seniors, Welltower's Seniors Housing Operating (SHO) portfolio is well positioned to take advantage of this trend. With a supply-demand imbalance, the portfolio is expected to see sustained occupancy growth in 2025 and in the years to come. Taking advantage of these positive factors, Welltower's SHO portfolio is prepared for strong revenue growth over multiple years. In the fourth quarter of 2024, the same-store net operating income, NOI, for the SHO portfolio increased by 23.9%. This marks the 9th consecutive quarter of growth exceeding 20%. Management expects the SHO portfolio to achieve solid same-store NOI growth in 2025, with expectations of continued high growth in the years ahead. The third stock in our video today is Intuit Inc., ticker INTU, in the application software industry. Intuit provides accounting software, QuickBooks, and an online marketing platform, MailChimp, targeted at small and mid-sized businesses. The company also offers TurboTax, a retail tax filing tool, Credit Karma, a personal finance platform, and a variety of professional tax services for accountants. Founded in the mid-1980s, Intuit holds a dominant market share in the United States for both small to mid-sized business accounting and self-service tax filing. Intuit has a very safe dividend safety score of 98, with a strong credit rating of A negative, and a very fast dividend growth of 15.4%. It has a very low payout ratio and also very low net debt to capital and EBITDA, with 13 years of consecutive dividend payouts. INTU has a levered free cash flow of $5.01 billion, a current ratio of 1.36, $18.83 billion in revenue, and an Altman Z Score of 8.14. It has a return on invested capital of 22.45%, with a wide economic moat and exemplary capital allocation. Intuit's TurboTax Live platform is significantly improving profit margins, driven by the projected growth of the US tax software market, which is expected to increase at a compound annual growth rate, CAGR, of 10.1% through 2030. The company's investments in AI are enhancing developer productivity, lowering costs, and improving profitability, leading to a marked increase in earnings before interest and taxes, EBIT margins. Additionally, Intuit's strategic expansion into the mid-market and the integration of its products, especially QuickBooks and Credit Karma, contribute to a positive long-term growth outlook. The fourth stock in our video today is Cisco Systems Inc., ticker CSCO, in the communications equipment industry. Cisco Systems is the largest provider of networking equipment in the world and one of the largest software companies globally. Its main business areas include the sale of networking hardware and software, where it holds significant market shares, as well as cybersecurity software such as firewalls. Additionally, Cisco offers collaboration products like its WebEx suite and observability tools. The company primarily outsources its manufacturing to third parties and has a substantial sales and marketing team of 25,000 employees across 90 countries. Overall, Cisco employs 80,000 people and sells its products worldwide. CSCO has a very safe dividend safety score of 91, with a very strong credit rating of AA negative. CSCO has a low payout ratio, with low net debt to capital and EBITDA, with 14 years of consecutive years of dividend payouts. Cisco's shift towards AI networking solutions and security products is expected to lead to sustainable revenue and cash flow growth. This transformation is bolstered by partnerships with companies like NVIDIA and the integration of Splunk, which enhances capabilities in AI infrastructure and real-time security monitoring. The company is seeing significant growth potential driven by AI, supported by strong free cash flow, a rising dividend, and strategic alliances. These factors position Cisco for capital appreciation and dividend growth as demand for AI infrastructure increases. Cisco's Q4 results were impressive, with optimistic guidance and solid product growth, fueled by momentum in AI infrastructure, strategic partnerships in the Middle East, and consistent earnings beats. The fifth and final stock in our video today is one of Warren Buffett's favorite stocks, Chevron Corporation, ticker CVX, in the energy sector. Chevron is an integrated energy company engaged in exploration, production, and refining operations globally. It is the second largest oil company in the United States, producing 3.0 million barrels of oil equivalent per day. This includes 7.7 million cubic feet of natural gas and 1.7 million barrels of liquids each day. Chevron's production activities are located in North America, South America, Europe, Africa, Asia, and Australia. The company's refineries, located in the US and Asia, have a total refining capacity of 1.8 million barrels of oil per day. As of the end of 2024, Chevron's proven reserves were estimated at 9.8 billion barrels of oil equivalent, which includes 5.1 billion barrels of liquids and 28.4 trillion cubic feet of natural gas. CVX has a very safe dividend safety score of 90, with a very strong credit rating of AA negative. CVX has an uninterrupted dividend streak of 113 years and had increased its dividend during the past recession. Chevron has a levered free cash flow of $14.43 billion and $189.27 billion in revenue, with an Altman Z Score of 3.72. Chevron Corporation is well positioned to benefit from higher than expected natural gas demand, driven by a forecast of a colder than average winter. This could lead to increased natural gas prices, enhancing Chevron's profits. The company's acquisition of Hess Corporation and its expansion in Guyana further support its potential for sustained growth, alleviating concerns about production plateauing in the Permian Basin. Additionally, Chevron offers a strong dividend yield, making it attractive to investors. The company's strategic initiatives, including efficiency improvements and the Hess acquisition, are designed to support long-term growth and enhance shareholder returns. With strong cash flow generation and consistent dividend growth, Chevron remains appealing to investors. Today, we have looked at 5 solid stocks that we once held in our portfolio that we thought would be good to analyze and present to our valuable subscribers. Kindly check the description for terms and tickers used in this video. As we come to conclude this 12-batch videos of our winning stocks, we plan to release a special video for you all next week, where we will share our winning strategy that helped us outperform the S&P 500 since we've created our portfolio last year, with a total IRR on the portfolio of more than 50%. We would like to thank you all for staying till the end, and we wish you all have a successful investment journey. For more content, kindly like and subscribe.